Hey guys, Akil Stokes here. Welcome back to another episode of The Trading Edge, the very first of 2022. Hoping you guys have had a happy holiday season and a great start to your new year. If you guys are brand new, I'm a Forex trader. I'm also a trading coach over at tier1trading.com. And this is the weekend I've been doing, this is a video I've been doing every weekend for the last, 6 or so years, giving you a breakdown of different trading opportunities that are on my radar, as well as very important trading lessons. I think it's important that we do a mix between both. It's one thing to show you the charts, show you some technical analysis, put some trading ideas on your radar, but my main goal is to help traders, and most of those lessons come from off the chart. So I love those types of discussions. If you're brand new, by the way, hit that subscribe button. Make sure you hit that notification button. That way you don't miss any of my videos. I've been doing live streams every Tuesday, Wednesday, and Thursday at 7 a.m. New York. Feel free to join as I share my top trading idea for the day. Now, one of the discussions that we had to start the week was a warning about the start of a new year or the start of any new trading period, because this is always a very delicate time. Not to go too deep into it, I did write an article if you want to read about it in more detail, but the beginning of the year is a very emotional time. Everyone's got new goals, new standards, new ideas, and a lot of things can go wrong. If you start off really hot and you do great, then you have these false expectations. You may get overconfident and start doing dumb stuff. One of the biggest habits we see is people raising their position size too much. I spoke to a trader the other day who said he got off to a hot start. He started increasing his position size, so his risk per trade. He hit a cold streak, and that cold streak wiped him out. Already, it's only been a week. On the other hand, maybe your current results don't live up to your expectations. You start the year with new ideas, new strategies, new techniques. You expect to come into the market and kill it right away, and maybe the market has something else in store, and then you start bailing on your system and doing that system hopping dance that lands traders in trouble as well. So it's important that you put yourself on a plan where that obviously you want to have a trading plan, but you commit to sticking to it for a month, 2 months, 3 months, a full year, and then not let your emotions sway you one way or the other based off the very first week of trading. Trust me, this first week is insignificant, I should say. For you guys that have been with me on YouTube for a while, I think it was 3 years ago where I put out a YouTube video. I was all excited for a great year. I had some new ideas. I was pumped up. And I started the first 6 weeks of the year in a drawdown. And I stuck with you guys through that journey. I said, trust me, it's early, plenty of time to turn things around. And what do we do that year? We turn things around. So as Aaron Rodgers once said, RELAX, right? Relax. And I got a good example of kind of false expectations and one of the emotional pulls that traders can get sucked into this weekend. A buddy of mine shared with me an Instagram post, which you can see in front of you, of some amazing returns, 136% here, 141% there, 183, 295. If you took all 4 trades, you would have made over 750%. Fire emoji, right? And traders, I hope the audience that I'm speaking to doesn't believe this type of stuff, right? We had a cool accountability session on Friday where, a few of the traders mentioned the reason they joined us at Tier 1 is because they got tired of the snake oil salesman, and we gave you guys a realistic view of what to expect for trading, and that's something that we pride ourselves on, right? We were doing that before it was cool, and we took a lot of flack for it, but we're doing the right thing for the right reasons. But you see stuff like this, and it does one of two things for a trader. One, it makes you go crazy and start over trading because you believe that you need to make this percentage, and if you haven't done it already, you're a loser because this person has. Or two, you bail on a perfectly good system. You have something that is chugging along, making consistent returns, but it's not enough. So you over leverage, so you add more, you take more. And it's very important before you ever get into live trading that you have the proper expectations of what you should expect from your trading. Now, you should get that from your backtesting results as well. And if you haven't done your backtesting, you shouldn't be live trading in the first place. But you need to admit that, hey, these type of returns, although maybe you can make them, yes, we all had big days, big weeks, they aren't the norm, right? This isn't sustainable. You're not going to be able to consistently produce this. Trust me, if you did, well, just do the math on your own. Understand what a realistic return is. And I was talking to the traders this week, and I said, hey, you know what? What if I told you you can make 1% a week? Would you be happy with that on average? Right? Yes, no, right? Type your comments below if you want to share why you would not, right? A lot of people would say no, right? 1% is a measly amount, especially compared to the 750% return that you could have got following this person's signal. But the truth about investing is that power comes from the bigger picture. Power comes from consistency over time. And although 1% doesn't seem like a lot at first, if you can consistently produce 1% a week, all of a sudden that grows and grows and grows, right? So 1% a week is going to end up being about 4% a month. 4% a month is going to be about 48% a year, right? That is a massive return. And I want to do some math with you real quick. And we'll even do this. We'll take that 1% and we'll split it in half. So let's say you average a 0.5% per month, right? So you get a 24% return a year, right? Let's say you're starting with a $10,000 account. This is what it looks like in your $10,000 account, right? Your starting capital was $10,000. At the end of, let's do a single year, actually. We'll start with year one. End of a single year, you made $2,400, right? You know, some of you are probably like, but trust me, we want to remember we're worried about percentages, not the monetary figure. Now let's fast forward to 3 years, right? Oh, all of a sudden you've almost doubled your money. Let's fast forward to 5 years. If I can get my buttons working correctly, right? 5 years, you've almost tripled your money, right? It is massive, and that's not even counting making individual or additional contributions. And if you've heard any of my podcast about wealth creation, wealth building, and how you can kind of double down on trading, what you want to do is you want to have your money working for you in the market. And then as you're continuing to make money in your own regular job, your hobbies, your side business, whatever it may be, you can take some of that money and then put it into your trading account. So now you have a bigger trading account. That 1% that you made off your $10,000 account is now 1% off a much bigger account. Your profit is more. That 1% gets even more and more and more. You can see how it starts to kind of compound over time. By the way, that all starts with having your personal finances in check, but that's a story for another day. The point is, right, have a realistic expectation of what is good from the market. Don't fall for all this, I don't want to call it scammy stuff because I don't like talking about people I don't know, but if it seems too good to be true, it probably is. However, if you have the right expectations about trading, you could have that too good to be true kind of return. It's just going to take a little bit of time, but trust me, you're going to do it in a much safer way than trying to do it like this. So that's my ranty rant for the day. I always do that. I hope it's not that long in the future. Let's hop into the charts and we'll get started with my number 3 trading idea for the week ahead. All right, so let's kick things off with the number 3 trading idea for the week ahead. And we're going to be here on the pound New Zealand daily chart, so looking higher time frame. Typically, I try to keep these weekend ideas on a higher time frame. That way, if you're watching this video a little bit late, you still have a chance to kind of capitalize off of it. But this is going to be an old school structured trading opportunity, a counter trend trading opportunity where you can see price action has rallied up into a previous level of structure resistance. And what we want to pay attention to here is how price reacts. And we want to look for signals of a hold. Now, it's very important unless you're very aggressive, which I personally am not. I don't think there's any reason yet to just sell at market and assume that price is going to hold. Again, we want to be predictive in our analysis, reactive in our execution. So we want to predict key levels to pay attention to and then wait for price action to give us clues before we react, meaning getting involved in the trade. But this is certainly one that we want to pay attention to for a few reasons. I'll give you a few reasons of why I like it, and then give you a few negatives as well. And then one of those negatives is going to be the reason that it wasn't higher on my list of trades of the week. So we have a few things happening, right? We have price action coming up to a previous level of structure resistance. As you can see, that line. We have a pretty decent candle combination to end the week, right? We have a high momentum bullish candle right here with a little bit of a rejection at the top as we approach structure. Look left, structure leaves clues. Again, personally, I love to see those rejections. We end the week with a very positive day. This is one of my favorite candlestick patterns. This is one of the most powerful candlestick patterns out there. This is going to be, I call it a pin bar. There's different names out there. It doesn't really matter what you call it. This is a very powerful candlestick pattern, and what it represents is essentially the buyers trying to push up. They do so for a portion of the session. However, by the time the day is done, right, by the time the dust settles, they have been completely rejected. The bears or the sellers have won the day, and they've won the day in really a confident type of fashion by being able to close at the very bottom. If you want to add some support to that, you can see the RSI, the Relative Strength Index. This is massively overbought as well. The default for this indicator are going to be 70 and 30. I like to use 80 and 20, so I look for extreme overbought and oversold scenarios, and you can see we're even above that at about 86 on the end of the day. We also have declining volume, right? If you look at the very bottom of your screen, you can see a volume indicator here. You can see that although volume is still technically rising, it is a lot less than what we've seen in the past in comparison, and lower volume in a directional move is not very good for continuation of that directional move. So those are some of the negatives, some of the things that we can use to support this idea. The negative, or some of the positive, excuse me, one of the negatives is that we have an overlapping levels of structure, right? So if we look left a little bit more, if we put our VS1 levels on, I'll load that up real quick and you'll be able to see it. Just reload it because it's the weekend. You're going to see that this is actually a bigger VS1 level above here, right? So we have our current level of structure right here, this small box, but we have this bigger box as well. And one of the reasons I like having this indicator on my chart is because in case, let's say I'm only looking at this area and I tend to think that this is the only level of importance, this is kind of a big slap on the back of the head that says, hey, Akil, remember, look left, structure leaves clues. There's something else here that we should pay attention to. And the thing about these overlapping levels of structure we want to pay attention to is they are typically highly competitive zones. So those are zones that, you know, a lot of rookie traders will place stop losses above the most recent high, forgetting about the level of structure or consolidation that was previous. And smart money, insiders, whatever you want to call it, they know that. So a lot of times you'll see stop losses be put right up here way too early. You'll see those stop losses be picked off. There's probably some of that happening right here with this spike. And then after those stop losses are picked off, the price will make its way back down. So you want to be careful of those overlapping levels of structure. They are dangerous. I always tell our traders that the higher level of structure is the most important one. So be aware of that, and we have different protocols on how to handle those situations. As far as where we're looking for price action to go to, we'll draw out a line here at our previous level of structure. The neckline of this head and shoulders is a good shelf level to look for target location. Of course, we can add to that with confluence. We'll do a simple one, just take a Fibonacci retracement from our swing low to swing high, see what we get there. Not a lot of confluence. I guess you can shift down to the 382 if you highly value fibs. I'd keep it right here at structure. We have the 197 even handle as well, which is a pretty decent location to project targets. Trading idea number 2 is going to come on the New Zealand Swiss. Once again, we're going to be on the daily chart, talking higher time frames, giving you time to watch this throughout the week. This is going to be a good example of one of my favorite patterns to trade in the market. It's also going to be a good example of morphing patterns. So when one thing turns to another. So for you guys that have on the platform that have taken the Foundation 2 course, there's a good section there about morphing patterns. This is a perfect example of that. And a morphing pattern essentially is when you have one pattern and then it doesn't really play out the way you expect it and it turns into another thing. And as traders, it's important that we're flexible, right? We can't be locked into a single thing. We can't be, we got to be stubborn to a certain degree, but we can't be stubborn to the fact where we refuse to redo our analysis. Sometimes we have to admit that, hey, although it was something a few days ago, it is something different now, and now I have to adjust my analysis and prepare a different way. And you see so many traders get in trouble simply because they are stubborn and they never change and they fall in love with their analysis, and once it's on their chart, they refuse to change it and they get bit in the butt by it. So can't be stubborn when it comes to that type of stuff. But what we have here is a descending triangle forming. So we have price action coming down. We actually made like a little double bottom type action here, and then we refuse to break higher. And what we've essentially done is we put in a consistent pattern of decreasing highs. So our highs are getting lower, 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 lower highs, lower highs. This is not going to be an exact lineup right here, but we've got equal lows here. So we have price coming down, bouncing off the same level, right? So this is a good sign that we are losing momentum to the upside. Each time the buyers try to push up, they're getting weaker and weaker. On the other hand, the sellers are maintaining the same type of strength by being able to attack and approach the same bottom. So typically what happens in this scenario is you see the bottom fall off and you see a breakout to the downside. Now, something I like about this particular pattern as well is the overall analysis, right? Not only is this a descending triangle where I would predict a breakout to the downside, but it is a descending triangle that comes after a violation of our most recent VS1 level, so a previous level of structure support. So I already have that bearish bias just based on my normal rules for how to read a price chart and support and resistance and all that fun stuff. Now I have a bearish pattern lining up, right? Bearish analysis, bearish pattern. Got that good confluence. Everything is lining up in the same direction. That is a positive sign for my prediction. Now, a few places I would look to break out to. Obviously, we have this nice level of support down here, but I do think there's another level that we should pay attention to, and it's going to be right in here, right? Hard to tell, but we have a 61 even handle, right? So a psychological number. We have a nice candlestick right here. So this is another area of consolidation before a breakout. I like to call these elephant candles. If you're into supply and demand, this probably shoots out to you as well, but a nice little consolidation before the next big break. And also we have a pretty decent level of confluence there, right? If I take let's take a few things here. We'll go through kind of like a CTS checklist. We'll start with an AB equals CD pattern from our bigger move. So if I take a 1-to-1 measured move from this swing high to this swing low and attach it to here, boom. You can see nice 1-to-1 confluence there at 61. If I take my Fibonacci extension and I drag it from this most recent swing right here. Let's take this most recent swing high to swing low. We can do the bigger one as well, see what that gives us. You can see we're going to have a 127 right in that area. Let's see what the bigger one gives us. Just curious. Swing high to swing low right here and back up. 127 a little bit below, and let's just do one more from that original AB equals CD since I'm curious now. Swing high to swing low of the AB, and boom, a 127 at that level. So a nice little zone here between really 61 even with the AB equals CD pattern, and then our kind of block of 127 extension. So again, when we're doing stuff like this analysis in general, nothing's going to be pinpoint accurate. What we're trying to do is we're trying to identify zones, and then we're making a decision where is the safest place within that zone. And in this circumstance, it would be 61 even for me. So before we hit my top trading idea for the week ahead, I want to do a little shameless promotion. If you like what you see here, if you want to see more of it on a regular basis, meaning trading ideas, live sessions, you want to download some software, you want to take some courses, sign up for the 14-day risk-free trial membership on our website, www.tier1trading.com. It's risk-free because there's no auto bill or anything like that. Once your 14 days are up, you simply lose access and you're booted out. But 14 days is plenty of time to get on the platform, download the software, hop into some live rooms, jump into an accountability session, network with the community, and take a training course. So www.tier1trading.com, check it out, and let's check out this number one trading idea. Finally, trading opportunity number one, my best trading idea or my top trading idea for the week ahead is going to be on the dollar yen. Now, if you've been following me on a regular basis, this is going to be a revisit from something that we looked at or we've been tracking this past week. And in fact, we actually did a YouTube video on this. I've been doing a live stream each and every morning at 7:30, a public live stream. We always have the live room, obviously, but Tuesday, Wednesday, Thursday, if you want to join me 7:30, we've been live streaming my top trading idea for the day. So the number one trading idea that's on my radar. And this is one that we looked at. So if you want to go back and check out that analysis, just check out the video from Tuesday. I think it's called New Year Warning, something like that. But we're looking for a continuation here on the dollar yen, right? You can see if we zoom in a little bit, we have recently cleared our VS1 level right here, our previous level of structure resistance, giving us a higher high, higher close. higher high, higher close allows us to make the prediction that price is likely to go higher. If we're likely to go higher, then where are we likely to go higher to, right? You can tell this is that process, right? When you have a rules-based trading plan, a rules-based process, right? There's no kind of, mystery or confusion in your analysis. You're basically going through step 1, step 2, step 3, step 4. If you're someone that doesn't do that, I highly recommend it. It's going to make your life a lot more easier. It's also going to allow you to avoid a lot of those emotions where you're like, hey, I think, I feel. It's none of that is involved. It's either 1, 2, 3, 4. It's as black and white as we can possibly get it. But if we're likely to go higher, then we're likely to go to our next level of structure up here at the VS1 level. And again, you can go back and watch the previous video for target ideas and whatnot. But what we've done here is we did halt. We started putting in a retracement, and now we're looking for the area and where that pullback is going to end, and we can potentially see that next extension. So in this circumstance, I'm going to dig down or dive down to my lower time frame, right, the 4-hour chart, and see if we can get a better idea. Now, we were holding this, there was a smaller zone here on the hourly that we were watching. We had a nice hold here, but no real signs of, to buy, right? Especially with the, we want to be a little bit cautious as well with the non-farms. And it looks like we've ended up breaking that by the close of the week. Now, I would expect us to dive down to this VS1 level right here or somewhere in this zone. And if we do, we're going to have a nice little pattern set up as well. So another area of confluence. If I take this last move up, this would be my X to A, my impulse leg. This first retracement is going to be my A to B. We come just past the 50% mark, which is going to put me on alert for a bat pattern. We then get another retracement, or a failed extension, I should say. And if we can push back down to this 886, 115.10, this is going to give us a bat pattern completion, with the zone being from, again, this decompletion 115.10 all the way to our X leg at about 114.94. So nice little psychological number there as well. But this is going to be a bullish bat pattern, so an advanced pattern formation where you would be looking for a buy. And of course, this buy lines up with the overall analysis that we had anyway of waiting for a pullback and looking for a chance to get the extension. So again, a nice little kind of double type 2-for-1 type of deal here, where you have an advanced pattern formation, which would be a bull buy in its own right, and you have it lining up with a potential higher time frame pullback trade as well. So for you guys that want to get advanced with your advanced pattern formation, this is one where you can start splitting up your positions and doing some funky things with it, where you let one ride, or of course you can just use this as an entry reason into the bigger pullback trade as well. This is going to be an aggressive entry for me, so I'm personally hoping this gets filled as well. So before you leave, do me a favor, hit that like button, subscribe if you're new. I put out videos almost every day, so if you don't want to miss them, make sure you subscribe so you can check them out. Also, if you have any questions or comments about anything discussed in the video, or anything trading or personal finance related in general, feel free to type it in the comment section below. I do go through them, I do read each and every one. I will respond, and many of them turn into Trading Coach podcast episodes as well. So keep the good ideas coming. Hoping you guys have a great week of trading this upcoming week. And until next time, plan your trade, trade your plan. Take care.